Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
The outlier possibility, and it is very much an outlier that we don't see because we just don't see cooperation on a global scale among the major industrialized world anyway at the moment, is this idea that's been forwarded by Soros, and it was even an idea that was actually brought up back in the 1940s, I think it was, 30s and 40s by Keynes, and Keynes wasn't quite happy with the Bretton Woods systems. It didn't really come out the way he wanted it to. He was looking for some type of centralized currency unit with some type of flexibility band in which the other major currencies of the world could trade around. The problem for the global system is when you have one currency, i.e. the U.S. dollar, that is the center of the system, you get a lot of different funny things and dislocations. And because the dollar has to be the world currency, it kind of forces the U.S. into these kind of long-term or permanent current account deficits. And the reason that is because the U.S. dollar as the global world currency, because it took the place of gold, which was the center of the system, it has to be that lubricant that liquefies global markets. So unfortunately, the U.S., the Fed, and kind of has a dual mandate. They have to apply dollar credit to the world, at the same time they're providing dollar credit to the U.S. economy. Sometimes it seems like they think about the global economy first and the U.S. economy second. Other times it's just the opposite. Also, because of the fact that the U.S. Is the center in the global world currency, often our monetary system has to be reflected and matched in other places in the world that peg their currency to the U.S. dollar. So when we're very, very easy, they tend to be very, very easy at times that may not make sense for the business cycle. So it creates a lot of dislocations when you have one particular currency at the center, but unfortunately that's where we are, and we seem to be stuck, and we have to live with it. But I think this idea of the dollar going away, you can see pretty clearly is not the case here. Especially when you think of the point what the risk is now to this whole blue area, dark blue area here, which represents the euro. There's still a very good chance that the euro could go away, and if not go away, fall in value tremendously even from where it is today. And if that were the case, who's going to take up this slack? And I think you'll see the U.S. dollar increasing here in terms of its allocation across the board. So I don't think there's going to be a big change anywhere in the near future in terms of this picture, other than possibly the U.S. dollar increasing here. With all the sovereign problems and the European banking problems, and I'll get to that in a bit, going forward in Europe, it's unlikely you're going to see major portfolio allocations, increases in major portfolio allocations until this stuff gets sorted out. Who wants to sit on either periphery European or even core European bonds other than Germany with what's going on in Europe? Less and less we think that's going to happen, and we think the euro is still in very, very big trouble. No doubt the dollar won't get all of that reallocation outside of the euro. Gold, we think, will get much of it. And in fact, we're seeing once the euro started to get in trouble from a potential structural standpoint, when the market recognizing the structural problems, we started to see, and we're still seeing it, gold and the U.S. dollar moving in correlation on a longer-term basis. And we haven't seen that we just haven't seen that in the long-term cycles in the U.S. dollar and gold. There's always been very much a mirror image, but of late we're seeing them move together, and to us that really suggests the deep portfolio risk in the number 2 global currency, the euro, and not the U.S. dollar. So I think that's something very important to keep in mind, that in here, if this risk continues, we could see both the gold and the U.S. dollar moving together. I think we made the points pretty clearly on these things, but number 5 is a very big point here. And again, when I speak to some people on occasion, and they say, well, how could the U.S. dollar ever do well? The U.S. deficit is soaring. The Fed is out of bullets. They don't know what to do. We can't fund our future liabilities. All that is true, and all of it is very ugly, and none of it is good. But when you look at this, the depth of the capital markets in the U.S. alone is somewhat of a savior to the U.S. dollar and has been in many cycles to a large degree, and that's what's happening here. The credit crunch, when we had the credit crunch, a lot of the analysts got it right in terms of the credit crunch coming, but most every analyst got it wrong in terms of what the dollar was going to do. They thought if the U.S. stock markets fell off the cliff and gold soared, the dollar had to fall. But it's precisely the opposite, and I think most people are now learning it, and it's an important point. When we have a global conflagration in the world, the deep portfolio money cannot hide in the Malaysian bond market. It just isn't there. I think a lot of players would like to have another opportunity, but they're forced into the depth of the U.S. capital markets, and that tends to be dollar supportive, and that's why we say there's no real alternative to the dollar because of the relative depth of the capital markets. And the European problem just intensifies that in favor of the U.S. dollar. Again, what's primarily on the headlines is the news that China's getting out of the U.S. dollar. They're going to run from the dollar, and therefore that's what's going to drive it to zero. But the reality of the situation is that if you look at China in terms of its demand base, it's still very much locked into the U.S. consumer as the driver of of their export growth and their GDP. The consumer's percentage of GDP in China is 35%. That's pretty much off the charts in terms of being low relative to its global economy. I mean, it's very imbalanced on the export side. No doubt that Chinese consumers, on a real basis, are increasing their purchasing power, but on a relative basis, relative to the size of the economy as it grows, the consumer is still a desperately low share, and that means that China is still highly dependent on the U.S. consumer and external demand. So it doesn't behoove China to run out of the dollar per se or try and teach the U.S. a lesson because it kills really its major driver of demand on the U.S. consumer. This will change. This will change as the demand increases in China. There's some very good pieces out lately talking about this idea that as China starts to, because of the increase in labor costs in China and the ability of China to finally start building really public housing for people out into the hinterlands and really finally taking all those migrant workers that have been displaced and didn't have the ability really to put down roots and save and become real consumers. As that starts to change, you're going to start to see the spending habits change and the consumption habits change. And again, we agree with that, but it's going to be a slow process. We say in this cycle, China is still locked into U.S. demand, so there's no reason for them to punish the dollar. Now, the outside problem here is there's always a caveat to this stuff, and the caveat here is there's a potential for some major problems on the trade front. Frictions are really increasing across the board with China and all its trade competitors, and the U.S. is number one. We have the U.S. election cycle coming up, and we never can underestimate the ability of a U.S. politician to exploit a problem. And the problem is China has been increasingly what is very, very hard on international competitors that they force to come inside to China and build plant and equipment and that type of thing. But yet they, with all their particular, under the World Trade Organization, they have these really implicit barriers, these implicit regulations that keep a lot of the international firms away from the consumer that they need to get to in favor of their local competitors, local Chinese companies in a very, very big way. We've seen the European Union finally starting to voice these concerns. The U.S. Chamber of Commerce is forcing these concerns even more. We're even seeing a lot of the Asian bloc countries that were afraid to voice these concerns speaking up. So if we get into a major trade war, this idea of China selling off U.S. bonds as a tit-for-tat in a trade war really comes into play in that situation. So again, there's a caveat to all of this, and that's the caveat here.
Thank you for listening to our podcast. Please visit www.ise.com/podcasts